To break down what to do next is Lisa Shalett, Morgan Stanley Wealth Management CIO. Lisa, the jobs number certainly helps feed the soft landing narrative and the view that the Fed can cut rates this year. Should that be positive for equities?
Look, I'm a little bit of a skeptic here. I don't think anybody knows anything. I think we were due for a little bit of a lighter payroll number after the streak that we've had of upside surprises. Our read of the labor data is that it's still quite mixed. And while I know that the market got itself a little bit offsides in terms of positioning with regard, to worries and fears about a hawkish Fed, and they obviously didn't get one because Chair Powell never goes there. I just think that there's a lot about the repositioning that we're seeing that is just that. We're going back to an estimate on Fed funds futures for about 2 cuts as opposed to less than 2 cuts. And that's probably about where we should be at this point.
So then why are you not feeling better about the equity market, which loves rate cuts?
Well, I absolutely believe that this is a market that loves rate cuts. But the question is, what are the rate cuts really going to buy you? The parts of the market that have been, most successfully rewarded, some of the mega cap tech companies, some of the generative AI stories, some of the cyclicals, for the most part, they've been interest rate insensitive for a large part of this cycle. They've benefited from the fact that higher interest rates didn't matter. And so one of the things we're reminding our clients is, if they didn't matter on the way up, they may not matter on the way down. So for us, lower interest rates are going to help those who've been left behind, right? So who are some of those? They're the unprofitable companies. They're the small companies. They're small cap. They're, some of the emerging markets, type companies who are very interest rate sensitive. And so that's where we would be buying today. We wouldn't be piling into the stuff that's already expensive, was already interest rate insensitive, and now suddenly, the belief is, we could push the multiples even higher.
Do you have confidence that inflation numbers are going to start to come back down? It was a good sign to see average hourly wages, but some folks are paying attention to the prices paid in the manufacturing numbers, which were firmer. Of course, we got that employment cost index. And there are still questions, right? I think we get the next CPI the week after next on the 15th.
Yeah, we're not convinced. We're not convinced that we're on a sustainable path to 2%. Do I think that there are clear indications that disinflation is in the economy? Yes, I do. But look, the super core inflation numbers have been accelerating for literally 10 months straight. And we shrugged it off for a really long time, but I think that there's real inflationary pressures there. We know that the housing market, which is key to these CPI readings, single-family housing prices are continuing to hold in there. I mean, the latest national housing numbers are up over 6%, up over 7% in urban areas. So, I don't think we're wholly out of the woods yet. Let's just remember today's number, even on our average hourly earnings, as you talked about, 3.9 is less than 4, but just, and 4 is still 2 times 2.